Welcome back to Smart Stock Sam, the channel where we cut through the noise and deliver the kind of deep market analysis that actually moves your portfolio. I want you to pay close attention today because what I'm about to share might be the most time-sensitive, deadline-driven setup we have covered recently. Right now, a sub-dollar artificial intelligence stock is sitting on what could be one of the most compressed short-squeeze setups we have seen in months. A CEO has made a public promise he literally cannot walk back without destroying his credibility. Institutional heavyweights are quietly accumulating shares. And a hard deadline, May 15th, 2026, is ticking down. The stock is Datavault AI. The ticker is DVLT. And whether you already own it or you have never heard of it, the next 15 minutes of your time could be some of the most valuable you spend this month. Now, before we get into the charts, the deals, and the squeeze mechanics, I want to set the table. Our video title says it all. The CEO has made a bold, no reverse split promise directly to shareholders. That one statement changes the risk profile of this entire setup, and we are going to unpack exactly why and what it means for you specifically before that May 15th earnings call drops. We are going to walk through the complete picture, the new business architecture, the three deals powering the pivot, the institutional footprint, the bear case you absolutely cannot ignore, the technical setup, the short squeeze mechanics, and the precise trading levels that matter. Let's get into it. For a long time, Datavault AI was viewed as a legacy play, a pure data monetization business, doing fine work in a space that does not generate the kind of exponential growth narrative that AI investors are chasing. That chapter is now closed. As of this report, dated May 3rd, 2026, Datavault has officially pivoted into vertically integrated AI infrastructure and cybersecurity. And that pivot was built on three major catalysts that, when you understand how they connect, paint a radically different picture of what this company is actually worth. I call this the Catalyst Trifecta. Every single piece of it matters. And the market, in my view, has not fully priced in what these three things mean working together. Let's start with the infrastructure layer. Datavault is no longer just selling data. They are building what you might call the pipes and the shields for the AI economy. Their new technology stack is built around three critical pillars: artificial intelligence compliance, quantum-resistant encryption, and GPU edge networks. Think about what every major corporation is terrified of right now as they rush to adopt artificial intelligence. Two things keep the C-suite up at night: regulatory fines from compliance failures, and quantum computing-enabled security breaches. By offering a one-stop solution, GPU infrastructure bundled with AI compliance and quantum-ready protection, Datavault is positioning itself less like a software vendor and more like a utility company for the future of the internet. That is a completely different valuation framework than what the stock is currently trading at. Now, into the first deal. The CyberCatch acquisition. This is a cybersecurity firm out of Canada, valued at $136,800,000 Canadian dollars. And here is the first thing that should catch your attention. It is structured as a 100% all-stock transaction. No cash leaves the company. No debt is added to the balance sheet. What comes in is CyberCatch's AI-powered continuous compliance platform. And more importantly, what the industry is calling Q-Day protection. Q-Day refers to the hypothetical but increasingly discussed moment when quantum computers become powerful enough to crack every form of current encryption in existence. When that day arrives, companies without quantum-resistant infrastructure will be critically exposed. By absorbing CyberCatch into its stack, Datavault is not just protecting today's data, it is future-proofing it for the next era of computing. The binding letter of intent is signed. This deal is live. Could a sub-dollar stock with quantum-ready cybersecurity infrastructure really stay at 74 cents much longer? What would it take for the broader market to finally notice what is being built here? Now for the second deal, and this is where things get genuinely impressive from a financial engineering perspective. Datavault has secured a $120 million cash contribution from Scilex Holding Company. That capital is earmarked for a 100-city GPU edge network rollout. 100 cities, powered by someone else's capital. But here is the critical detail that most retail investors will walk right past. This deal is explicitly non-dilutive. Scilex does not receive new shares. Your ownership stake is not watered down. Instead, the structure is a 30% gross revenue participation model. Scilex writes the check. Datavault builds the physical GPU edge infrastructure across the country. Profits are shared on the back end. The company gets to scale to 100 cities using a partner's balance sheet, while existing equity holders keep their proportional ownership intact. That is genuinely unusual for a company at this price point and this stage of growth. And the third piece of the trifecta is perhaps the most unconventional of all. Through a partnership with King Mining Capital, Datavault has secured the rights to 20,000 ounces of physical gold. And they secured those rights at a 30% acquisition discount to market value. The plan is to tokenize that gold on the blockchain, blending the old world stability of a hard asset with the new world efficiency of digital infrastructure. The projected arbitrage profit from that discount alone is $40 million. That is not a future projection tied to revenue growth. That is an immediate capital cushion built into the current deal structure. A cushion that directly supports the 100-city GPU rollout without putting additional pressure on the balance sheet. When you step back and look at all three of these deals together, you are not looking at a company that is just issuing press releases. You are looking at a company that is systematically solving its own capital problem while building infrastructure for three of the fastest-growing sectors in technology: artificial intelligence, cybersecurity, and blockchain-based asset management. Each deal funds or enables the next. That is genuine strategic synergy. Now, let's talk about who else is paying attention, because the smart money has already done their homework. Right now, there are 85 institutional owners holding over 36 million shares, approximately 5.27% of the total company. And when you look at the names on that list, three of them stand out immediately: Vanguard Group, State Street Corporation, and BlackRock. These are not speculative funds chasing a penny stock lottery ticket. These are the largest asset managers on the planet. When institutions of that caliber appear on the cap table of a sub-dollar stock, it signals that institutional-grade due diligence has already been conducted. They are not here for a quick flip. They are building exposure to a structural growth story. But here is where I have to be completely straight with you, because this channel is built on honesty, not hype, and there are legitimate concerns on the other side of this trade that you need to understand fully before making any decision. The bear case is real, and it is being argued loudly. Total share count is approaching 700 million shares. For context, that is a massive float for a company at this price level. And dilution is the central argument of every skeptic watching this name. There are also open and unresolved questions about the Vivasor related party transaction, specifically whether an independent valuation was completed before the deal was executed. 75.9 million shares were issued in connection with a $50 million investment, and critics are pointing to that ratio aggressively on retail platforms. The bulls see future potential. The bears see current opacity. Both sides deserve serious consideration. This is the core tension of Datavault AI in one sentence: a management team that is moving fast and issuing shares while simultaneously promising to protect the equity value of current holders, which brings us directly to the promise that is the centerpiece of everything we are discussing today. CEO Nathaniel Bradley has publicly stated that he will never support a reverse split. In the world of small-cap stocks, a reverse split is often the equivalent of a corporate distress signal. It consolidates shares at a ratio that effectively reduces the number of shares outstanding at a higher per-share price. And it almost always signals that management could not get the stock to compliance organically. By taking the reverse split completely off the table, Bradley is making a very specific and very public bet that Datavault AI will reach the $1 compliance threshold on its own merit, driven by the fundamental growth of the business. That is either the most confident thing a CEO can say about his company's near-term trajectory, or it is an extraordinarily high-stakes promise that creates enormous downward pressure if May 15th does not deliver what investors need to see. So let's look at the technical picture and figure out exactly where this stock stands right now, heading into that date. The relative strength index is at 55.9. That is firmly in the neutral to buy zone. Not overbought, not exhausted, with meaningful room to run on the upside before momentum becomes a concern. The moving average convergence divergence is flashing a buy signal at 0.007. And critically, Datavault is currently trading above its 5-day, 20-day, and 50-day moving averages simultaneously. When you see that kind of alignment across multiple timeframes on a daily chart, it tells you the trend is healthy and directional. Weekly signals still carry some residual selling pressure, but the daily and hourly readings are pointing to a strong buy condition. The path of least resistance right now is upward, and then there is the short squeeze setup. And this is where the technical story and the fundamental story collide in the most explosive way. Over 81 million shares are currently sold short. That represents 18.51% of the float. That is an enormous percentage by any measure. But here's what makes the setup even more compelling. The borrow fee on those short positions is currently 18.55% per year. The bears are not just wrong if this stock moves. They are actively bleeding capital every single day to maintain their positions. With 3.88 days to cover, the math on a potential squeeze is straightforward. If any meaningful positive catalyst hits before the shorts can cover gracefully, they are all racing for the same exit simultaneously. That is a textbook short squeeze scenario. The spring is coiled, the trigger is on the calendar, and that trigger has a name and a date. The Q1 earnings call, May 15th, 2026. The market will be watching for two specific deliverables. First, definitive agreement confirmation from the Scilex partnership, not a letter of intent, but executed documentation. Second, official confirmation that the CyberCatch merger is moving toward close. But the single outcome that would fundamentally change the conversation is any credible evidence of revenue beginning to flow from the Scilex GPU deployments in New York and Philadelphia in Q2. If Datavault puts revenue on the board, the dilution narrative loses its primary weapon and the growth story steps into the spotlight. If they do not, the bears press harder and those support levels become absolutely critical. Here is exactly where those levels sit. Primary support is at 73.2 cents, the Fibonacci S1 level. Secondary support converges at 72.3 cents, where the 20 and 50-day moving averages meet. On the resistance side, your entry signal is a confirmed break and hold above 75.2 cents on rising volume. Target 1 is 86 cents, reclaiming the April highs. Target 2 is the $1 psychological barrier, which is simultaneously the 200-day moving average and the key threshold for long-term exchange listing compliance. Your stop loss sits as a trailing stop below 68 cents. That is the level where the bull thesis structurally collapses and you are no longer trading a setup, you are holding a falling knife. For perspective on the upside potential, certain analysts currently carry a buy rating on this name with a price target of $3. At 74 cents, that represents a potential move exceeding 300% if the full thesis executes. Could a sub-dollar stock with institutional backing, a non-dilutive 100-city GPU deal, quantum-ready cybersecurity technology, and one of the most loaded short floats in the small-cap space realistically trade to $3 on the strength of a strong May 15th earnings delivery? What would have to go right, and what would have to go very, very right for that to happen? Now, before the final verdict, this is the moment where Smart Stock Sam has to pause and be completely transparent with you. Nothing in this video constitutes financial advice of any kind. I am not a licensed financial advisor or registered investment professional. All content presented here is strictly for educational and informational purposes only, based on publicly available data as of May 3, 2026. Small cap and sub-dollar stocks carry a substantial risk of total loss of invested capital. The deals, projections, and analyst targets referenced here are based on company announcements and third-party sources and have not been independently verified by this channel. Past performance is never an indicator of future results. Always conduct your own thorough due diligence. Always consult a qualified, licensed financial professional before making any investment decision, and never allocate capital that you cannot afford to lose entirely. With that said, here is the final verdict on Datavault AI. This is a company in the most consequential phase of its existence. On one side of the ledger, you have a vertically integrated AI infrastructure pivot powered by a non-dilutive 100-city GPU deal, a quantum-ready cybersecurity acquisition, a $40 million gold tokenization program, institutional backing from 3 of the largest asset managers in the world, a technically aligned chart pointing higher, and one of the most loaded short setups we have tracked this quarter. On the other side, you have a 700 million share count, unresolved transparency questions around related party transactions, and a CEO whose personal credibility is now publicly tied to the $1 compliance threshold. May 15th resolves everything. Watch for a confirmed break above 75.2 cents on rising volume. Respect the support at 73 cents as your floor. Now here's the question I want you to answer in the comments section below. CEO Nathaniel Bradley has publicly pledged no reverse split, staking his reputation on organic price discovery. Do you believe that promise reflects genuine, data-backed confidence in where this business is heading? Or is it a calculated move designed to protect retail sentiment heading into a critical earnings deadline when the company needs maximum goodwill? Leave your honest, thoughtful take below. I read every single comment, and I will be engaging directly with responses this week. If this breakdown gave you an edge today, hit the like button right now. It takes 2 seconds, and it directly helps this channel reach more investors who need this level of analysis. If you are new to Smart Stock Sam, subscribe today so you never miss a high-conviction setup like this one before the catalyst hits. And if you want to go above and beyond in supporting the work we do here, you can send a super thanks directly on this video using YouTube's built-in channel support feature. Every single contribution goes straight back into research tools, data subscriptions, and bringing you faster, deeper, and better content on the names that matter. I will see you next time.